America screws the 90%. I have a side business. Necessary and ordinary, you can make your dependents whatever you want. Intent to make money. Bad Donnie. Donnie, you shouldn't have taken that write-off. You shouldn't have done that. See what, like, the difference between rich person and criminal is? It's pretty great. Real estate, man, it keeps losing money. I don't know what's going on, IRS. The tricks are endless.
Oh my goodness.
Woohoo!
What's going on? Alex here, and today we're going to take a look at some terrible tax advice. That's right. I, as a CPA, am going to respond to a video that was put out by a popular YouTuber called Meet Kevin. He talks about 15 different things that can supposedly save you on taxes, but as a tax professional who deals with income tax issues on a daily basis, I'm going to give you my perspectives and show you how most of the advice that he provides in his video is absolutely terrible and can get you in a lot of trouble if you take him by his word and apply what he says without consulting with a qualified tax professional. All right, so this is something a little different than I usually do, but hey, let's have some fun with it and check this out. So where does this guy even come from? This is Meet Kevin. He's got a popular YouTube channel. Very nice, very good. I understand and respect the hustle. Bunch of subscribers going on. Very good. But when you get into my income tax world, I have to observe this stuff and respond. And why? Because I have clients and prospective clients all the time that reach out to me and say, hey, Alex, I heard of this. Can I do this? I want to deduct that. I heard I could do that. And there's this credit available and that workaround and loophole and all this stuff. I always ask, where do you get this information? Some of it comes from YouTube, friends, family, real estate people, their attorney, what have you. But when you get into the nuts and bolts of it from an income tax perspective, we'll see how dangerous bad tax advice can actually be. All right, let's check it out.
Poor people work a job and spend their take-home money. Let's say, oh, I got a phone or I got a new laptop. You take the money that you earned, the government takes their taxes out of it, and whatever's left you use to pay your cell phone bill and your computer. Rich people do things differently. They say, I have a side business. This side business lets me write off expenses even if I'm losing money on this side business. But as long as they're necessary and ordinary, I get to write them off and get a tax check, basically tax deduction for that money.
I have a side business. All right, there's a lot more complexity to that than is apparent by watching this, because just having a side business doesn't mean you can automatically deduct everything in your life, claim it as a business expense, and you're going to have no problems, okay? It doesn't work like that. If you have an activity that you engage in on a continuous basis with a profit motive, it essentially, from an income tax perspective, has to rise to the level of a trade or business for you to be able to deduct expenses. And I hear this nonsense all the time where people say, hey, you know, you set up a little business, quote unquote, and you siphon all your expenses through that. That can be extremely problematic because as a tax preparer, if I get an income statement for a business and there's very little income and there's a whole ton of expenses, then I'm going to have questions because huge losses on Schedule C, which is where you report losses from a sole proprietorship business, can be a significant audit flag. And we want to make sure that if there are big losses that we're including on Schedule C, that they make sense and that they belong there. And when you just apply all of your expenses to an activity that may or may not constitute a business, they can be then disallowed by the taxing authorities, and you would then be dealing with the taxes, penalties, and interest that can result from that. And those can be extremely substantial, all right? These issues that can arise from misclassifying personal expenses as business expenses can be life-changing in some cases, all right? So don't play fast and loose with what's a business, what isn't a business. And I hear this nonsense all the time where people say, oh, just start a business and all your expenses can be siphoned through it. Doesn't work that way. It has to rise to the level of a trade or business based on the facts and circumstances and the intent of the taxpayer, all right? So let's continue.
Anybody can start a side hustle, even if it's a money-losing side hustle, and take advantage of business deduction.
Okay, let's hold right there. Having a money-losing side hustle can be an issue, all right? Because there's a rule out there that basically says, and I'm not going to get very technical here, we're going to keep this basic. If you have losses from a business activity in at least 3 out of the last 5 years, then there's a rebuttable presumption that that activity constitutes a hobby. What does rebuttable presumption mean? It means that the taxing authorities can say, hey, this looks like a hobby because you haven't made money from this activity over the last few years. And from a business perspective, if something is losing money, why would you keep doing it unless you were doing it for personal enjoyment, if it was a hobby, something like that. So from that perspective, you can very much be in the situation where the taxing authorities will just say, hey, this activity that you've been deducting expenses for, since there's losses in each tax year, we're not going to look at that as a business. We're going to reclassify as a hobby, and all of those deductions are going to go away. So you can have additional taxes, penalties, and interest, and the penalties can be quite significant because there is also a penalty called the substantial understatement penalty. That is a penalty added above the other tax penalties just to punish you for being way off with regard to what your taxable income should have been versus what you reported. All right? So very dangerous stuff. Aside from that, he talks about taking expenses for a business you can have down the line. You cannot, in general, deduct expenses for a business that has not started operating. Instead, you must capitalize many of those costs, meaning you put them on the balance sheet and you deduct them once the business becomes operational. So in taking deductions for a business you may have down the line, that can be a huge issue because we're not even looking at whether or not the deduction is a business expense or not. I mean, that is important. But on a whole nother level, we're also considering that you should have no deductions for the most part for a business that has not started yet. So this guy is a complete clown. And if you even start to head down this path, you're going to find that a lot of tax preparers are not even going to want to work with you because there's so much risk inherent in this that both you and the tax preparer can be in trouble once all of this unravels, and very often it does, unfortunately. So just keep that in mind. Let's continue.
As long as you have an intent to make money.
There are those
which
quotes
brings
again.
up number 2. Poor people call stuff they do hobbies. Rich people call everything a business and another additional stream of income.
All right. Again, you can't just have 15 different things that you dabble in throughout the year and all those are trades or businesses. Doesn't work that way. The IRS loves to pick these things apart because in many cases it's a surefire home run for them and they're going to wallop you for a good amount of additional taxes and penalties. And don't forget, at the state level, they can also do the same thing, all right? Be very careful in applying advice such as this from a non-tax professional. I can tell this guy has never prepared a tax return, and he can have his videos, he can have his views and subscribers. I'm all for it. I'm supportive of it. But when you step into my world and you start telling people a bunch of nonsense, I have to react to it. I mean, that's just me. But
if you make YouTube videos and you treat it like a hobby, that is, you spent $2,000 on cameras and lights and tripods and all this stuff, rich people say, I'm going to take that $2,000 and call it a business expense for my new startup.
More quotes.
And that $2,000 is probably going to translate to $600 coming back to me from the IRS thanks to tax write-off.
And what do you guys know at this point, right? You know that has to be ordinary necessary. It's based on the intent of the taxpayer, and the facts and circumstances will dictate whether or not you actually had a business. You have to understand that making one YouTube video in 3 years is not going to carry the fact that that's an active trade or business, all right? But if you're doing it continuously, let's look at this from the other perspective. If you're doing YouTube videos continuously, regularly, with a profit motive, you're out there marketing it, you're getting new equipment, you're getting viewers, you're promoting it, that can very well rise to a level of a trade or business. And then what he's saying would be applicable, and now you could buy cameras, lights, microphones, other equipment, and take those deductions. So in that case, when you have that intent, you have the facts and circumstances working in your favor and that you're actively involved in it, you're continuously involved in it, and your goal is to make a profit, at least in the short to mid to long term, then you can very well take these deductions. So this is not something that's not available, but I see far too often that somebody watches a video like this and all of a sudden their basket weaving activity that they engage in 3 times in the last decade is a business, and here's a whole list of expenses that I'm looking to deduct. Can't do it.
So don't call things hobbies like poor people do. Instead, call things a business like rich people do. That means if you have a cooking show, the pots and pans that you're buying would be business expenses if you actually intend to make money from that business by having a show on YouTube. Think about it. Number 3.
Again, it depends on every situation, but if you bought a bunch of equipment, pots and pans and all this stuff, you got all the spices ready to go, and you never actually begin that business, there's a big question as to whether any of that is deductible from an income tax perspective. And we have to step back. We have to look at the situation, and we have to see if you had the intent of actually going through it, and that will guide the conversation moving forward. In some cases, you can make the case that it's a failed business venture, but for the most part, have a tax professional guide you through this. Don't get into a mess by just throwing everything on the expense side and hoping for the best. Let's continue.
Poor people say, oh, sweet, tax refund day. I'm going to buy a new TV. Rich people say, tax refund? Oh man, I messed up. I just gave the government a free loan. I'll adjust my W-4, Google that, IRS W-4, so that way I take home more money every month by adjusting my dependents up. Even if I don't have more children, you could make your dependents whatever you want.
You can make your dependents whatever you want. You heard this clown, right? Now let's take a look at Title 26, Code of Federal Regulations. Here is the section, and it's called False Information with Respect to Withholding. Let's read. Civil penalty. If any individual makes a statement under Section 3402 related to income collected at source, which results in a lesser amount of income tax actually deducted and withheld than is properly allowable under Section 3402, and at the time the statement was made, there was no reasonable basis for the statement, the individual shall pay a penalty of $500 for the statement. This penalty is in addition to any criminal penalty allowed by law, and this penalty may be assessed at any time after the statement is made until the expiration of the applicable statute of limitations. You can't put whatever you want on Form W-4. And aside from that, you don't put dependents on Form W-4. You put withholding allowances on Form W-4. And you can't just make dependents up out of anywhere. I'm trying not to do air quotes. I mean, this video is going to be full of them anyway. At the end of the day, what the IRS may do is issue what's known as a lock-in letter to your employer. So if you're employed by ABC Industries, they're going to get a letter from the IRS with your name on it saying, withhold this much from this taxpayer and don't allow them to change it. And a lock-in letter may be applicable for 3 years, all right? And it's triggered by improper withholdings on Form W-4. Now, it's one thing to adjust your W-4 correctly so that the proper amount of tax is withheld. That is applicable and something that everybody should do. But in terms of trying to free up additional cash more than you are able to based on your situation, to invest that difference throughout the year and try to circumvent the system, you're going to be looking at a lock-in letter, and it can get ugly very quickly. And I don't think you want your employer seeing that you are playing all sorts of games on the tax side, because they might look at you a little different from that point on, all right?
This is dangerous and can be dangerous, so it's a little iffy. You know, I'm not a CPA, so talk to a CPA.
I'm a CPA. I'm telling you that this stuff that he talks about is very dangerous, okay? So you heard it here first, folks.
I can't give you tax advice, but this is what rich people do, okay? I'm just being clear here.
No. Let me clarify. People have misconceptions about this all the time. Rich people have actual businesses that they're conducting. They could have multiple businesses. They could have 10 different businesses. They could have 20 different rental properties. But where you see the most amount of issues is somebody that makes 40 grand a year and they give you 200,000 of business expenses for their basket weaving activity that generated $14. That's a problem. I'm not going to touch that tax return, okay? Because at the end of the day, you're putting your name on it and I'm putting my name on it as a tax professional. That's where the issues arise. We have to separate out a legitimate business enterprise and the income and expenses, how we treat those, with nonsense, where you have to use air quotes to justify it. Two different things, two different worlds. Don't get mixed up in a situation where you thought you're going to have all these deductions and it doesn't pan out.